A fact no one can dispute. Life happens. Meaning, we will all die, regardless of whether you believe in life insurance or not. But one question you must ask yourself is, how will your loved one cope financially after your death? For those that do not believe in life insurance, I hope you have enough assets to care for your family. But for those that believe in life insurance, how much insurance should you get? Stay tuned. Hi teasers, my name is Linda, your money teaser. Here I give money teasers on personal finances so that you and I can arouse our dreams. Today I will talk about how much death benefit you should take to be adequately insured. But first, if you're new here, please be sure to subscribe to my channel and turn on the notification so that you won't miss out on any video I publish. Let's get started. There are many factors that determine how much insurance you should get for the things that you want to insure. One of those important factors is the value of the thing you want to insure. The rule of thumb for buying insurance is to get enough insurance to be adequately insured. Adequate insurance means taking enough coverage that can fully replace your asset if something was to happen to it. For example, you take enough insurance to insure your home up to the value of your house. By doing so, the home insurance company will hand you a check up to the value of your house in case of a damage caused by a tornado. What about life insurance? How much death benefit should you take to be adequately insured? Is the $10,000 your company offered you at hire as one of your benefits enough? Is 1 or 2 times your annual salary enough? How much insurance should you buy? In order to answer this question, you should know your worth to your family. Unfortunately, life insurance will not bring you back to life. But the death benefit of your life insurance policy can certainly help provide financially for your family when you check out of this world. Therefore, it is important that you know your value to your family. And by value, I mean how much you do for your family financially. Your value to your family determines how much death benefit you should take to be adequately insured. In this video, I will discuss 4 methods you can use to determine how much death benefit you should take. And once you determine how much death benefit you need, you can choose the life insurance of your choice to get your coverage. If you have no idea about the different types of life insurance policies out there, make sure to check my video on term insurance versus permanent insurance. In that video, I talk about the different type of term insurance policies as well as the different type of permanent life insurance policies. Let's start with the first method, which is 10 times your annual income. 10 times your annual income is the most basic method of all 4 methods I will talk about in this video. With this method, you should take a death benefit that is 10 times your annual income. For example, if you make $50,000 a year, you should get a $500,000 death benefit. Why 10 times your annual income? 10 times your annual income because it will replace your income for the next 10 years. Hence, giving your loved ones the possibility to get back up to their feet after losing you. Though the 10 times your annual income rule is a good place to start when determining life insurance, it does not take a detailed look into your family's need. Hence, the second method that will take into account your family's obligation. This method is called the DIME method. DIME is an acronym for debt, income, mortgage, and education. The DIME method is a way of estimating how much insurance you need while taking into account your family's obligations. All you have to do is to add up all the obligations outlined in your DIME to determine how much death benefit you need. Let's discuss each of those obligations in your dime. The D in the dime stands for debt. Teasers, let's get a record straight. Contrary to what most people believe, you do not die with your debt, nor do your debt disappear after you pass away. Someone will have to take care of your debt. And in most cases, it will be your next of kin or your estate. Your estate is comprised of all your assets at the time of your death. Those that die with their debt are those that die broke, because they leave nothing behind for their creditors to come after. In this case, their creditors are out of luck. But for as long as you leave some assets behind, your estate will repay your debt. Make no mistake. Here is what will happen to your debt after you pass away. If you have a joint account with someone, your spouse for example, your spouse would inherit debt on that joint account. If somebody was kind enough to co-sign that impossible loan of yours, know that that person will be responsible of your loan after you pass away. That is why you don't co-sign a loan you're not willing to repay. If you have a secured debt like payment of a car or a home, they will be repossessed unless someone agrees to continuous payments on them. Here is something very important to understand. When you write your will, in it, you appoint a person that will execute it. In other words, you name someone that will carry out your financial wishes. If you fail to leave a will, the probate court will appoint somebody to do it for you. This person that is designated by you in your will or by the court is your estate executor. After you pass away, your estate executor is in charge of managing your estate asset and distributing your asset to your beneficiaries according to your wish. This is a very important task. And in some cases, if your estate executor mismanages your estate assets or fails to pay your estate debt before allocating assets to your beneficiary, he or she can be held responsible for your debt. I don't know about you, but I would hate to see my loved one fight with my creditors for the money I leave behind for them to use. That's why you have to plan on how your debt will be repaid after you die. It is a responsible thing to do. A great way to have your debt repaid after your death would be to leave a debt benefit that can pay them off. Hence, to use this strategy, you have to add up all your debt, and the total of your debt should be included in your debt benefit. This debt includes, but are not limited to, your medical bills, which are actually the first debt your estate will pay, your credit cards, your car loans, your payday loans, and your private student loans. It is also advised to add your final expense as part of your debt so that your family can give you a befitting burial. Now let's move on to the next obligation in your dime, your income. The I in the dime stands for income. Just like the first method that consisted of taking a debt benefit of 10 times your annual income, with the dime method, you multiply your income by the number of years you estimate your dependent will live off of it. By doing so, you will provide enough income for your family to depend on in order to maintain the same standard of living you gave them until when your dependent become independent. For example, if your last child will graduate from college in 8 years, you could add 8 times your annual income onto your debt benefit. Now let's discuss the M in the dime. The M in the dime stands for mortgage. If you own a house that you're still making payments on, your life insurance proceeds should be able to pay off your house. That way, your family won't stress on making future payments on the house. The final obligation from the dime method is the last letter, which is the letter E. The E in the dime stands for education. We're not talking of your education, but we are talking of the education of your children, if you have any. As parents, we would like to see our children have a debt-free education. That is why some of us open 5 to 9 accounts to save for our children's education. Hence, accounting for the estimated future cost of education for your children in your death benefit will provide a fully funded education for your children if you were to pass away today. By adding your dime, which represents your obligation, you get a better view of your needs, which represents the amount of death benefit you should sign up for. Let's assume you have $5,000 left on your car loan and that you have a credit card with a balance of $5,000. That gives a total of $10,000 you have as debt. Let's also assume your family will need about $10,000 as final expense to do your funerals. The total of your D in your dime is $20,000. Let's also assume that your annual income is $50,000 and that it will take approximately 10 years for your children to become independent. You multiply $50,000 by 10, which gives you a total of $500,000 for the I in your dime. We also assume that you have a mortgage with $180,000 left to be paid off. Finally, you have 2 children that you would love them to acquire bachelor's degrees. You assume the tuition, room, and board cost to be $25,000 per year per child. Knowing that it takes about 4 years to get a bachelor's degree, we multiply $25,000 by 4. That gives a total of $100,000 per child. But since you have 2 children, you multiply $100,000 by 2. This gives a total of $200,000 for the E in your dime. If you add everything up, you realize that you need $1 million worth of life insurance. With $1 million of life insurance protection, the beneficiary will have enough money to pay $20,000 of your debt. The beneficiary will also continue to have $50,000 per year for the next 10 years or more to come. He or she will have money to pay off the remaining $180,000 of the mortgage, and he or she will still have $200,000 saved up for the 2 kids when they are ready for college. I know that $1 million sounds like a lot of money, but trust me, you would be surprised at how much you can get it for, especially if you are young and healthy. I'll do a separate video on underwriting and the cost of life insurance. But for now, if you need insurance, contact your life insurance agent. You can also contact me if you choose to. My email is provided in the description box below. I will be glad to help you. Though the dime method offers a well-rounded view of your needs, it is not comprehensive. A comprehensive approach to determining your need of life insurance will take your asset into consideration. This leads us to the third method of determining how much insurance you need. The obligation minus the asset approach takes into account your obligations as we determine them in the dime method and your liquid assets such as your savings account, existing college funds, and your current life insurance. All you have to do is subtract all your liquid assets from your dime. The answer you get is the gap that life insurance should cover. For example, in the previous example, we determined your obligations or dime to be $1 million. If we assume you have $100,000 worth of life insurance through your employer, $50,000 saved up in the bank, and $20,000 saved up in your children's 5 to 9 account, that gives a gap of $800,000 that needs to be filled. In this case, you will buy a life insurance policy with a death benefit of $800,000. What if you cannot afford premiums on an $800,000 insurance? That leads us to the fourth and last method to determining the coverage you should take. The last method to determine how much insurance you should take is your budget. Life insurance is of great importance to your family. Therefore, there is no need for you to get an insurance policy you cannot afford. Rather than taking a policy you will drop later, it is preferable that you sign up for what you can afford. That way, you get to keep it. After all, it is better to have something than nothing. Also, you could always increase your coverage in the future once you can afford to do so. Likewise, you should always review your need of insurance on an annual basis with your agent, especially when you have a major event in your life, such as a spouse, a child, a new house, an increase in income, and also more debt. Teasers. Now you can evaluate how much insurance you need to take to be adequately insured. While taking life insurance, do not forget your spouse if he or she is a stay-at-home parent. Even though stay-at-home parents have no income, they still need life insurance. Think about it. The stay-at-home parent works around the clock. He or she is the nanny, the tutor, the chef, the nurse, the driver, the planner, the accountant, just to name a few. Think about who will take care of those responsibilities if he or she was to pass away. According to salary.com in 2019, if a stay-at-home parent was to be paid for his or her services, we would be talking of a median annual salary of $178,000. If you're watching me right now and you are a stay-at-home parent, I salute you for your services. Teasers, I hope you have enjoyed this video. I highly suggest that you watch this video next, or you click here to watch the full playlist. If this video has been of any value to you, like, share, and subscribe if you haven't done so yet. Thank you for watching, and see you in the next video.